This is Real Tax, Real Insights, straight talk from the EY Center for Tax Policy in Washington, D.C., where we break down the tax policy developments that matter to your business. Today, we're addressing the U.S. international tax system as it exists after the tax legislation enacted earlier in July. We're going to go through a series of issues, including what are the potential impacts of the system today on U.S. multinational companies, and how is the rest of the world going to react to those changes? Joining me is Josh Ruland. Josh is a principal and the leader of the International Tax and Transaction Services practice in our National Tax Department. Josh advises clients on all aspects of U.S. international taxation, particularly on cross-border transactions. Josh, it's great to have you today. Let's get started. First question. Big tax legislation, early July, making a lot of changes in the international tax space. Some of the changes we expected, some we didn't. Share your thoughts with us, including how companies are reacting to those changes.
Jose, when the Republicans won both the House and the Senate and the presidency in November, we knew that tax was going to be a priority. We also knew the process was going to be messy. Like you said, we'd probably see some things we weren't expecting, but overall, we had a pretty good sense of where they wanted to go. Where they wanted to go is they wanted to make permanent many of the changes made by the TCJA in 2017 and to maintain the overall architecture of the international tax system. That tax system has four components. First, the U.S. corporate rate is 21%. That's pretty competitive with a lot of market jurisdictions and many of the U.S.'s key trading partners. Second, there's an enhancement on international income, a special deduction that reduces the rate on that income and makes it competitive with investment hubs, jurisdictions that historically have competed on taxes. The third thing is that we have foreign tax credit blending. Foreign tax credit blending isn't that common around the world, and it allows U.S. companies to reduce the effective rate on income, the international income, even further than the headline rate associated with this international regime. The fourth thing is the CFC regime. It was known as GILTI. They've changed the name to NCTI, but it's a regime that's a pretty favorable holding company regime. There's not a lot of residual U.S. tax imposed on foreign operations held through controlled foreign corporations. So as we expected, the tax legislation in July made many of these permanent, or all of these permanent actually, and it enhanced several of them pretty substantially. In particular, the regime for international income, we maintained the foreign tax credit blending, and the deduction went up very substantially in some cases. It's a pretty attractive regime now, very competitive. A lot of jurisdictions are taking notice. Secondly, it maintained the GILTI system. Again, it renamed it, but for all intents and purposes, the system remains the same and is in fact a little bit better than it was before. So companies are reacting pretty favorably to this. Again, for them it was unexpected, but a lot of them are reconsidering where they're going to hold their IP and other forms of generating profit.
So on balance, very favorable, right? Maintained generally the integrity of the system, made some changes, some expected, some unexpected. I think there's something in here for all companies across all different kinds of sectors.
That's right.
and industries, and makes the U.S. system just a more favorable place, competitive system across the globe. A lot of questions, though, on durability. The changes are permanent, right? But they're only as permanent until Congress makes other changes. That could be favorable or unfavorable. Thoughts on that?
Right. So this system was an enhancement of the 2017 TCJA. The Republicans had a sweep back in 2016. They enacted the TCJA, which created this international architecture. They enhanced it this year after they swept last November. And we don't expect that they would want to make any changes to it, at least unfavorable changes. They could be even more favorable changes, but they won't want to make unfavorable changes if they control the levers of power in the future. So what we expect to happen is the only time we think that there might be unfavorable changes is if Democrats both sweep all three, the House, the Senate, and the presidency, and they have a desire to make changes to the system. That part isn't really clear. So for them to have a sweep, they would have to win back the Senate. That's the primary focus for us. Right now, the Republicans have 53 seats. The Democrats will need to make some progress in the midterms in 2026 to get within shooting distance of that in 2028.
So potential for changes, but a lot has to align, come together. But even then, right, as you started out, tax legislation and getting it across the finish line is very complicated, but something we certainly have to keep track of. Final question, right? The U.S. system is not a standalone system. It's interconnected with the rest of the globes. system, so the rest of the world is going to react. What do you think the reaction is going to be?
Well, the reaction is going to be, the reaction is unknown, first of all. We're looking at it in three different buckets. First are the known changes. Pillar 2 is in flux. As a part of the legislative process, the U.S. negotiated a side-by-side system. We don't know the details of that yet. There's a lot to come, but that'll change the Pillar 2 regime for U.S.-based companies at a minimum. The second thing is DSTs, digital services taxes, and other taxes that the U.S. has identified as extraterritorial. They've taken a very strong stance against those taxes, and so we could see countries repealing those taxes, making changes to them, or who knows? There'll be some movement in that regard. The second bucket of things is, like you were saying, reactions to this more favorable U.S. regime. A lot of jurisdictions around the world have historically been investment hubs, and they've been competing on how favorable their tax system is, among other things. We'll expect them to take a close look at the U.S. system and potentially make some favorable enhancements to their systems to try and maintain competitiveness. The third thing is that market jurisdictions, many of our trading partners, have significant fiscal needs in the coming years. They've got demographic changes that are going to require additional revenue, and many countries are rearming. All of that is very expensive. So they're going to be looking to at least preserve their base. They don't want any of the income that's currently in those countries to move to the U.S. or any of these investment hubs, and they'll probably be looking for new sources of revenue.
So lots going to happen. The timing unknown, right? When you're negotiating with 150 countries, it's a more complicated process that could be a drawn-out exercise, but a very big focus of this administration. So something we'll just have to watch very, very closely.
It's going to be an interesting few years.
Josh, thank you for your insights, and thank you all for watching this episode of Real Tax, Real Insights. In the coming months, we'll be releasing more episodes featuring other EY tax leaders from the Center for Tax Policy, breaking down the most top-of-mind topics in tax.